And we talked about lending structure. So what I'm illustrating here is a real simple example where we've got on the left-hand side a home loan, personal debt, as I've called it there, which is secured by the home. And on the right-hand side, we have a potential, let's call it investment property, and we'll keep the same theme throughout. Probably the biggest thing that we see, and we've seen over many, many years, people make the mistake of cross-securitizing this particular scenario. So what that means is, if you go to the bank and say, I have now two properties, I own, I've got my home, and I want to buy this property, investment property over here, they typically will set that up under one loan and give you perhaps a few different loan splits underneath that. Great for them because they've got two properties or two securities, as they call it, with one loan. It makes it very inflexible for you down the track to do simple things like refinance part of the portfolio or part of your strategy that you see here. And it also allows you or restricts you in terms of being able to protect yourself and start to remove the home away from some of these investment transactions. So the picture here says the big line down the middle, on the left-hand side should be one loan, and this is how we set all of our customers up. One loan, and on the right-hand side should be loan number two. And they could also be two different lenders for that matter. And come back to my point earlier about there's a lot of noise about some banks not wanting to play in the investment loan space anymore. That's okay. There's plenty there that do and offer some fantastic products. So you might end up with your home perhaps on the left-hand side here with one of the major banks, and on the right-hand side might be with a tier two bank, but they offer some fantastic products around that. The other important thing here is offset accounts. So for those of you who don't run one, please go and explore it. And when you get my details at the end, I'm more than happy to work that through with you. Offset accounts can be very powerful. So in this sort of picture here, an offset account set up against the home loan should have all of your salaries going in there. So if there's two of you in the household earning income through a salary or some form of income, should be going in there. The tenant who lives in your investment property should, their monthly rent should be going in there as well. Plus, when you get that tax check back at the end of the financial year from the tax man because you paid too much tax because you own a property, should be going in there as well. That on its own can be very, very powerful in getting rid of that home loan that sits there. Remembering you can't deduct any of that interest that you're paying on your home loan, but you can on this wonderful thing down the bottom called line of credit. So the reason why we set up a line of credit separate from the home loan to be used to invest is so that from I suppose an accounting perspective, you're reporting correctly how much of it is deductible and how much is not deductible within your portfolio. So the earlier example where I gave the numbers around a negative gearing scenario, basically what it allows you to do is the loan on the right hand side here, which is the investment loan, can be geared say up around 80 or 90% depending on what you're comfortable at. So that's 80 or 90% of the value of that property. The balance of those funds that you need to complete that transaction actually come out of that line of credit down the bottom. And that way they're not coming out of personal savings or anything else that you've got sitting off to the side. The reason why we like that structure is because of that tax deductibility around the line of credit and the investment loan. So a good way to get started and be able to really start to, I suppose, carve out a path of building some wealth and then using that to hopefully get rid of that personal debt. So simple thing around home loans, we all love interest rates and quoting different numbers because that's what we do in the world today. For those of you on the webinar.